Good morning, everyone. Thanks for tuning in the webinar on 4th July. My name is Chen Guangzhi. I'm the oil and gas analyst in Phillip Securities. Today we will share the coverage on Semco Marine. Last week, we initiated the coverage on Sem Marine, and our target price is $1.60 together with our forecasted dividend of 4.6 cents. And compared to the last close price, which was $1.55, which implies a downside of around 22%. Here we compare the Sem Marine's historical price with the STI index and the Brent crude oil futures. As you can see that before the market rebounded in early this year, Sem Marine's price was quite highly correlated with the market. However, when the oil price recovered from below $30 per barrel to the current $50 per barrel, the stock price didn't move along with the oil price and the market. Here is the company background. Basically, Sem Marine is engaged in 4 major business segments: the rigs and floaters, offshore platforms construction, the ship repairs and upgrades, and the last one is specialized shipbuilding. We will elaborate later. So with more than 50 years experience in offshore and marine sector, the global deployment of the Sem Marine's global deployment has reached 10 countries. And in recent years, the financial report shows that North America and Europe are the major revenue contributor. So in the first quarter report this year, the net order book was reported at around 10 billion Sing dollars, and all these orders will be delivered to 2020. So there are 2 main points in the investment thesis. The first one is the oil market will slowly recover in the medium term, and the next one is the offshore and marine sector is still under the trough of the business cycle, and it is expected to recover in the next 2 years. Now let's take a look at the general oil market. According to the OPEC monthly oil market report in June, it showed that the oil glut last year reached 2.2 million barrels per day, and this gap enlarged to 2.6 million barrels per day. This was due to the sanctions against Iran was lifted in January, so the supply actually increased a bit. And it is estimated that the demand of global oil will reach 31.5 million barrels per day. As long as the major oil production countries fail to reach the agreement to freeze the output, it is estimated that the oil supply glut will last till the end of this year. So according to the EIA, it projects that the supply-demand imbalances will be eased by the end of next year. As you can see the green bars here, the oil stock in the 4th quarter of next year, it will close to 0, which means that the oil supply and demand will be balanced by then. So the World Bank and IMF also forecast that the oil price will increase gradually from now on. However, it is still below $70 per barrel 4 years from now. Now we will elaborate on the offshore and marine sector. So there are two subsectors in this industry, offshore wind energy and offshore oil and gas. The former one is still a blue sea market with huge potential room to growth. As we knew that Axion last week announced that they will form a JV with two state-owned companies in China to develop the wind farm land. However, the market size of this subsector is still small. So when people talk about the offshore and marine industry, what they mean is the oil and gas sector. The Baker Hughes provided the weekly data of the rig counts. So we compare this data with the oil price movement. As we can see that before the oil market crash, when the oil price maintained at around $100 per barrel, the rig counts actually fluctuated within the level of 3,500. However, when the market started to fall, the rig counts didn't decrease immediately. Only after 6 months later, it did start to decrease. When the oil price rebounded in March last year, again the rig counts didn't increase at the same time, but only rebounded a bit 2 months later. So it shows that the rig counts actually behave a lag with the oil price move. And this means that the rig operators face difficulties to adjust their operations during this low oil environment. Now let's take a look at the scenario of the three major types of rigs. You can see the jackup rigs here. Actually, the supply of the jackup rigs globally is more than the demand. And when the oil price was above $100 per barrel, the gap is within 100 units. However, when the oil price started to fall, the gap started to enlarge, which caused the low utilization of the jackup rigs. And even in May, the global supply of the jackup rigs still maintained close to 550 units. So the same pattern happens on semi-submersibles and drill ships. Though the supply of these units actually dropped a bit, but the demand dropped substantially to the current of 180 units around the world. And this also leads to the utilization rate drop to close to 60%. So this will trigger more delays or cancellations of new build deliveries within the market. So whether there are still business opportunities in the market, we should see the upstream sectors spending. So according to the IHS, the upstream exploration and production capex will drop to the low level since 2012 is estimated to be 169 billion USD this year. and after that the capex will be expanded next year. And also the McKinsey Energy Insights, they forecast more than 120 new jackup rigs will be enter the market in 8 years' time. And according to the Douglas Westwood, the deep sea projects such as the offshore platform, the drill ships and semi-subs will increase the capex in 2019. Now we will take a look at the floaters market. So there are various types of the floaters within this market, and the major types are listed here: the floater production storage offloading vessels FPSO, floating LNG, and the mobile offshore production unit. As you can see that this is the orders awarded in last year. It close to the level that the order awarded in 2008 financial crisis. So you can see that the current market is still facing the soft demand of these floaters. However, the McKinsey Energy Insights forecast that there will be 200 over new floaters delivering to the market from 2017 to 2025. And the Douglas Underwood estimate that the capex of this floater will bottom out next year. You can see the green yellow line here. And FSPOs is still the main demand in this market. Now we will see the offshore support vessels market. These are the specialized vessels that supporting the offshore and marine activities. So similarly, the supply of these units actually is far more than the demand, which jack down the utilization rate of the vessels existing in the market. And the current utilization rate has been dropped to the new low of below 50%. The last one we will look at the local ship repair market. So according to the Marine Port Authority Singapore, the number of vessels called for repair has been trending down since 2010. However, as far as the tonnage of vessels called for repair stabilized at a certain level, which means that the local shipyards actually increase their capacity cater for the larger size of vessels docked for repair. Now we will go to the investment merits of the submarine. So besides floaters and offshore platform segments still see the upward momentums, the rest of the segments will have a negative outlook. Rig building so far still it is still the main revenue driver, but you can see here the contract secured by each year in recent years. It dropped substantially since 2012, and even in the first quarter, submarine failed to secure any new contracts in the rig segment. So as of December last year, 20% of the net order books were on back-ended payment terms, which means that the clients will only make the full payment to Xamarine after the deliveries were made. And the rest 80% of the order books were subject to 30% of the upfront payment. Here the market has already raised the concern that whether Xamarine can safely collect the rest of the 70% of the payments on these projects. As in the past 1 year, two major client default events happened on Xamarine. One is that the Macro Polo Marine has terminated the rig orders valued at 290 million Sing dollars, though Xamarine has pursued claim against it. And another one is the Sea Brazil's event. In April this year, Sea Brazil's has filed bankruptcy, and previously it has already signed the rig contracts worth at 3.1 billion Sing dollars. However, Xamarine only made the impairment and provisions of 1/10 of the total value. The next segment is the floaters and offshore platform. As you can see that each of these segments managed to secure large size of contracts in every 2 years. And each of these and the cumulative contracts reach more than 1 billion Sing dollars. And even in the first quarter, each segment still had one project under planning and engineering stage, which means that Xamarine still have projects on hand to work on in the coming years. And so far, it didn't report any substantial client default in each of these two segments. The last segment is the ship repairs and upgrades. As you can see that the number of vessels that Xamarine repaired and upgraded in the past 5 years has been trending up. But the revenue per vessels earned by Xamarine actually is declining. This was due to the fierce competition within the ASEAN region, and especially those competitions from China and Korean shipyards. And according to the last year's report, Xamarine see the upward momentums of LNG repairing and upgrading works, but it is difficult for it to turn the whole segment's performance better. So in general, we think that Xamarine is undergoing tough period at this moment, since the overall oil and gas and offshore and marine sector will perform a U-shaped curve, and the bottom of this U-curve could last longer than expected from 3 years to 5 years time. So currently, we assume that Xamarine will have a negative outlook in the near term, but when the market started to recover, Xamarine's performance will turn better onwards. So during this survival mode, Xamarine has been conducting several measures to control their costs. For example, last year, they already optimized their labor force structure to match the labor force to the current project's workload. And secondly, it already started to promote their self-designed rigs projects. So according to the management, the self-designed projects can boost the gross margin to 15 to 20%, rather to hire a third party to do the design work that they only can earn around 10% of the gross margin. Lastly, during the market downturn, we think that it is a good time for M&As, as some of the market players, they may face difficulties on their operation and they will divest their assets to fund the operation. And at this moment, Sam Marine can acquire undervalue assets for the future growth. Here goes to our variation. This is the key assumption tables. So based on the current market conditions, we assume that this year, Sam Marine's new contract secure will drop another 25%, and it will recover next year and the year after next year by 12% and 20% respectively. Also, due to the order delays or cancellations, we assume that the percentage of the order book that will be recognized into the revenue will decrease in these 2 years, and it will increase back to the normalized level around 30%. As far as the ship repairs and upgrades, since management say that the phase 2 in Tuas Boulevard shipyard will commence operations in next year, we assume that the capacity will be ramped up so that the revenue of this segment will increase in the next 2 years. However, this year we still estimate that the revenue will drop another 10%. So we use the PE multiples as our valuation methodology. We simply take the average of the forward PE during the oil market crash from mid of 2014 till now, and derive the multiple of 12.2 times, and based on our estimated 9.5 SG cents EPS this year, we get the target price of $1.60. So we initiate with a rating of sell. Here is the last slide of the presentation, the investment risk. So among all these risks, the primary ones are the oil price volatility and the credit risk. As we know that the uncertainty of the oil price in the market will raise the concerns of the upstream sector's capex. Also, it will cause the counterparties to delay or cancel the orders already been signed. So that the credit risk will be the next biggest concerns of the Sam Marine. So here comes to the end of my presentation. Is there any questions? There is a question asked about what is the big advantage of Sam Marine compared to against Capital Corp. So far, we didn't have the coverage on Capital Corp, so we don't have any comparison between these two conglomerates. Okay, since uh, there is a question asking about the provision. It's only 1/10 of the total value of the contract signed from C Brazil. Um, we already asked them the management. However, they said that this is their own decisions, and based on our estimation, we assume that since the provision is so small that Sam Marine could possibly face more downside risk. There is a question asking about whether there will be some upside light in the tunnel for Sam Marine. We already show in the table here. So the catalyst for Sam Marine's price to go up is the oil price rally to the profitable level. And the second one is that the Sam Marine can manage to secure large size contract in the coming years, and on the condition that it can fully deliver all these projects. So the last one, though the chance is quite small, is that the Sam Marine's parent company, the Sam Industries, will prioritize it uh, on the condition that Sam Marine's stock price is traded far below its net asset value. And again, there is a questions asking about the whether the auditors still in proper impairment amount and will understand this impairment that will cause the balance sheets to be heavily impacted later. So we already say that as of last year, 20% of the order books were on back-ended payment terms. So we can make a guess that the SIP Brazil's projects, they already make 30% of the upfront payment, and they pay a big uh, with the work in progress going on. So we assume that these impairments is based on the current remaining unpaid uh, unpaid amount. So I think this amount is rationally decided by the management. And there is another question asking about the net asset value. So as of the December of last year, the book value per share is $1.20. There is a questions asked about whether the Korean and Chinese competition will kill submarine. The answer is yes or no, because at this moment the market is very negative. Even the Korean and Chinese shipyards is facing their difficulties. You can see like the COSCO's and Yangzijiang shipyards, they also making huge amount of losses last year. But however, with the support of the government, there will be more flexibility for them to survive in this tough environment. There is a question asking about besides America and Europe, what else could be the revenue sources? So within Asia, Singapore and Australia are revenue, the two major revenue contributors within Asia. And last year, the Singapore contributed around 290 million sinks, and Australia contributed around 550 million sinks SGD. Uh, Also, there is a question asking about whether the offshore wind will be big for San Marine. We think that currently the green energy market is still on the upswing momentum, but the market size of this wind farm land is still small compared to oil and gas. So we can say that in the foreseeable future, this sector, the wind farm, the offshore wind farm could be the new revenue driver for those market players within offshore and marine sector. Okay, since there is no more questions, we'll end today's webinar. We'll see you next week. Thank you.